recording the lecture. Okay, got it. Sorry about that. I apologize.
No
We,
problem.
we record these lectures now. So today we are going to really start focusing on the process of mergers and acquisition, because in the business world, this is the most significant way that businesses grow and expand. And so this is for the rest of the course. We're going to take each step in the process of a merger or an acquisition, and we're going to examine it so that we understand how these M&A deals are done, how companies defend against them if they don't want to be acquired. So this is the first step. And so today, what we are going to be looking at is the strategic part of this process, the very beginning. How does a company identify a target, a company to buy? And once the target is identified, we begin a process that's called due diligence, which is really important, no matter if you're the buyer or the seller, to understand before the deal is completed, how do we investigate a company to make sure that its assets and its valuation are correct? What kind of issues or problems are we buying? In English, we have an expression we use. We say, kick the tires. If you're going to buy a car, you want to kick the tires to make sure the automobile works. So really, due diligence is the process where we really examine the company to make sure it's something that the investors want to buy. So where we're going to start this discussion is strategic planning, which is the very beginning of the process. On Wall Street today, there are firms that have people that they employ that do nothing other than evaluate companies, public companies, for example, that could be targets for a takeover, for an acquisition. And so this is strategic planning, which is at the core of what we do when we start the process of an M&A. And so what do we mean when we say strategic planning? Well, here we're talking about how do we identify the company, how do we evaluate the company, and then once we've done that, how do we approach the company to see if we can make the transaction? So all of this is what we call strategic planning. And in a normal acquisition, the process from the beginning to the end, to the actual deal, could take anywhere from 6 months to a few years. It really can be a very lengthy process. Or if a company wants to move quickly, they will try to, speed up the process. But every deal goes through this strategic planning process in order to complete the deal. So this slide here shows us the overview of the process. And what's interesting about M&A that we're going to learn as we go through this together is that every deal is different. Companies, industries, the size of the deal, the strategy, the reasons behind the deal, all of them are varied and different. However, the process of what a company goes through in order to target another company, to buy, to merge, the process remains the same regardless of the size or the objective of the merger. And so this basic process that we see here in this slide, every M&A transaction goes through these basic steps. And today's lecture, we start the process of really evaluating each critical step in this process one by one, so we understand, okay, now we're in the beginning of an M&A. This is the strategic planning period. This is what a company has to do on both sides. And then, of course, we're going to end our lecture today talking about due diligence, which is the process of evaluating whether or not the target that we've identified as strategic is really a good investment. So the first steps in the process, here we see there's three main steps that we have. We are a company, and last week we talked about why do companies merge? Why do they target or acquire other companies? Well, sometimes companies merge to grow. Sometimes they merge because they want to try to dominate a certain industry. And sometimes they merge because they want to acquire complementary skills, operate in different parts of the world, any number of reasons. And so the strategic planning process forces a company to say, all right, what do we want to accomplish by merging? And so we go through this strategic planning process, which is a preliminary evaluation, market research, and then the third step in this process we're going to talk about is due diligence. What do we do once we've identified the target? And so let's talk first about the pre-deal evaluation. So say, Filippo, you and I work for a company and we both agree we really want to merge. We really want to get bigger. And so you and I would sit down and we'd say, let's develop a strategy. Okay. What is the industry sector we want to work in? Suppose we are selling products in Europe and we have to buy supplies from Asia. And you and I are talking and we say, I really wish we owned our supply chain in Asia so that we had more control over how we're bringing our products into the other market. And so you and I say, all right, let's agree to a vertical merger. Let's identify supply chain suppliers in Asia that we could maybe buy. So that would be one of our objectives. And so we go through this process. We identify the industry, the reason for the merger, and then the type of company that we want to buy. Makes sense, very logical. So let's take a closer look at this. So say in our example, we've said, okay, we want to buy a supplier. So now the first thing we do in our strategic planning is we've got to identify what are the traits, what are the characteristics that we're looking for in a potential company. So we could say in our search, this company has to be able to produce this supply or, in this volume. They need to be operating in a certain area. And so we go through step by step all of the things that a company we want to buy has, all of the traits, all of the characteristics. And so once we develop our search criteria, we start analyzing where they are in the market. From that, we can identify a list of companies. And then we decide, okay, now we've got a list of 5 potential companies. Now we have to contact them to see if they're interested in a merger or an acquisition. And then if they're a public company, we have to consider, is this company, if this company is not going to be receptive to being taken over, do we have to anticipate that they will try to fight the merger? And we're going to look at takeover defenses, which are very, very common if the acquisition involves a public company. And then lastly, we'll talk about tender offers and what they are and how they're used to complete acquisitions. And then, of course, we're gonna end in our lecture today talking about due diligence. Once we've gone through all of the steps of strategic planning, then we start a process that's called due diligence. And that means that, we've approached the company and we've said, we will buy your company for this amount of money. And then they say, yes, we agree. However, that's only the beginning of the transaction. What happens at that point is the process of due diligence has to start. And what that means is that, say you and I, our company is buying, we have to launch the review in order to verify that we understand what we're buying. And so the due diligence review involves a detailed review of the financial records, their operational, how is their company set up? What's the factory like? Legal. When I was in practice, I used to be involved in many, many legal due diligence reviews where you have to go in and understand, does the company have any potential legal liability? For example, are they facing any fines from any governments, any environmental violations, anything that would indicate that, we're going to buy this company, but once we do, we discover that this company has huge legal liability. So the process of due diligence will allow us to identify any sort of legal liability for the company that we're buying. And then, of course, environmental, human resources, what kind of, how big is their workforce? How many employees do they have? All of those things are part of our due diligence. And so this is the process that we're going to really focus once we talk about the strategy we go through to identify the target. But the due diligence process, in fact, our second homework assignment is going to be looking at due diligence and did in mergers, because oftentimes the reason why mergers fail is because companies didn't do a very good job of investigating and understanding the true nature of the company that they were buying. So the due diligence process is really a very, very important process in the M&A world. So let's kind of go back and talk about the strategy. The first thing we have to do is we have to understand the reason why we want to either buy a company or merge with a company. And this is really important because if we haven't done a good job of identifying what our goals or our objectives are in the transaction, we aren't going to find a suitable target or somebody to merge with, because we don't really understand why we want to buy another company or merge with another company. And so what we see here is we see a list of goals or objectives, that these are what many companies define as their goal before they decide to enter into an M&A. And so the biggest reason obviously is growth. Many times companies decide to enter into a transaction because they want to grow, they want to get bigger. But other reasons, sometimes they want to diversify. We looked at last week an M&A where RJ Reynolds merged with Nabisco. So you had a cigarette company and a food company that merged. And part of the reason was they wanted to diversify. The companies wanted to have diverse product lines. Another reason why companies merge is they want to save money. They merge with another company that may be able to manufacture products more efficiently or deliver services more efficiently. And so cost savings and improved efficiency are often big reasons why companies merge. Another reason why companies merge, they want to be more competitive. If we have two companies in an industry and each company has 20-25% of the market, if two companies merge, all of a sudden they're much more competitive because they're bigger in an industry. And then finally, this is the last reasons for mergers have really kind of, with the technology boom in the global marketplace, we've seen what we're going to look at is these value-added mergers, or mergers that are conducted so that companies can acquire new technology. So all of these are really important because this is the first thing a company does, and at the beginning of the process says, why do we want to merge? And it may be that they have more than one or two objectives. They want to get bigger and they want new technology, but this is the essential first step of an M&A is the why. Why do we want to do this? Because once we identify the goal, everything else in our strategy falls into place or must be consistent with that goal. It'll help us identify the market, the candidate, all the other things that we need to understand before we can go into a transaction. So I want to follow up and talk about the model or the method of the acquisition, because this is really important. Once we've identified the purpose for our M&A, there are a couple different kinds of models, basically a blueprint, that we're going to follow. So here are 4 of the most basic types of acquisition models that we use in an M&A transaction. The first one is vertical. We think of, a company from the bottom to the top of a straight line. It's a straight line, and the vertical merger is used when you have different companies that are complementary. And I will take the supply chain example that I gave you at the beginning of our lecture. We deliver products. We deliver products to a certain market. A vertical merger would be the supply chain is the best example. We want to buy somebody in our chain of distribution because we think it will make us more efficient, but we're different companies. This is a vertical model. They produce the product, we deliver the product. We're completely different, but we're complementary companies. This is the vertical acquisition model. The horizontal model is, if you think about the horizon or a straight line in a horizontal way, it would be 2 of the same or similar companies that decide to merge, or one buys another. That's a horizontal merger. It means, okay, so say I am a clothing company and I operate in a market, and I decide to buy another clothing company that's my competitor in the same market. That's considered a horizontal merger. And the reason why I go into a acquisition model in this way is because I want to increase my market share. I want to eliminate, or I want to be more competitive. So we use the horizontal merger when we are merging with the same or a similar company. And that's usually the reason why. In the vertical model, we want to improve our profitability and our efficiency. And that's why we merge with different but complementary companies. But in the horizontal model, we're basically merging with our competition in order to basically dominate the market. The third model is an interesting model. In fact, the merger that I just referred to, the R.J. Reynolds Nabisco model, is also what we would call a conglomerate model. And the goal is to diversify your operations. So if you look at big companies, global companies that offer many different products in many different industries, this would be a conglomerate. And usually a conglomerate merger is done so you can minimize your risk and basically diversify your operations. Let me go back to the R.J. Reynolds, the tobacco company example. When R.J. Reynolds, before they merged with Nabisco, they sold only tobacco. And that became a concern because you had all of the public health scrutiny that was given to smoking in, say, the 80s, for example. And so what happened to R.J. Reynolds? They started losing their customer base because less people were smoking. And in addition to that, there were lawsuits against R.J. Reynolds because people complained that they had misled consumers about the dangers of smoking, and so they had these big class action lawsuits. And so R.J. Reynolds was concerned at that point and said, we really need a conglomerate merger. We need to merge with another company that is doing something different. And this was a good example of a conglomerate model merger. They decided to merge with Nabisco, who made a variety of food products. And that's an example. They did that to diversify their risk so that they wouldn't be just dependent on one product. And so this is a good example of a conglomerate. And then finally, the value-added merger is one that has grown, particularly with the growth of technology. And it's called a value-added merger. As more and more tech companies come into the market with new technologies, new possibilities, many companies are turning to the model of a value-added merger. And so in a value-added merger, we could say we're not necessarily focused on buying our competitor or the supply chain efficiencies, but what we want is we want to bring two companies together to see if we can develop complementary strengths and create growth opportunities through mutual synergies. So this is kind of the value-added model, which is really coming about where we're a new, we have this technology, this other new company has this new process. We're coming together. We realize we may not make profits right away, but we think that there are synergies that will increase our growth in the future. So the value-added model is kind of a relatively newer model. Let's say a few more words about this value-added merger, which is really interesting and it's being used more and more as the global marketplace changes. And really, the value-added merger is an analytical model that evaluates potential acquisitions. And so if you were looking at targets in the traditional way, you would look at a company and say, you'd have one major focus. Will this target increase our profits? If we buy this company, what will it do to our profitability? So it really is the traditional way we evaluate mergers is by this traditional model of what's it going to do to our profitability? It's a bottom line analysis. But now, companies more and more are looking at a value-added analytical model. Basically, we're a company and we say, we like this company as a target. It's not going to necessarily increase our profitability immediately, but it was going to help us with a strategic transformation. It's going to bring complementary capabilities, technologies. So in this value-added model, we say, all right, we want to buy this company because it's not going to be profitable tomorrow, but in 5 years, 7 years, we're going to invest in a strategy that this company will help us grow. And the focus is not so much on profitability, but if we it means you're going to have more, more financial resources, which all of these things are value-added objectives of this merger. On the other side, however, you have to understand if we use this approach, it's going to have limitations. And oftentimes you have integration challenges when you have a value-added merger. It may be challenging to bring two complementary companies together because, you hope that, they will help each other, but they may have different cultures, they may have different approaches. And so you have to be very, very clear-minded about, can we bring these different but complementary companies together? The cost of integrating the two companies may also be very high. The third or another problem you have is because you're not following a strict profitability model, but you're saying we think there's value added, you run the risk that you're going to overpay for the target company because your evaluation is not strictly money, but we think there's a future value being brought. And it's a little bit of a gamble or a risk, but often in value-added mergers, you can overpay or you can pay more than the fair market value or the fair valuation of a company. And then finally, a value-added merger tends to be a very complex, complicated deal because, again, you're not just looking at the bottom line, profit and loss. You're trying to account for all of these other, intangible values. Another thing we have to look at in a merger, there's the value added issue, but we also have taxes. There's sometimes companies merge because of tax liabilities. And this can be a value related reason to merge with another company. For example, a merger can reduce the tax liability of a combined firm. How does that happen exactly? Well, so say that I'm a big firm and I have a big cash flow. I have a lot of cash flow, but I don't have a lot of opportunities within my company to invest in equipment or machinery, or I don't have ways that I can reduce my tax liability. Say I'm a professional services company or something. And so I also, if I return profits to my shareholders or return cash to the shareholders, it means I have tax liability because I'm declaring profits. So a merger or an M&A is often used to reduce tax liability. So if I merge with a company and all of a sudden I can revalue the assets of the target company and create depreciation of expenses and deductions for taxes, I can take on the losses of a target company that I can deduct, and I can carry them forward in future years. So oftentimes, and I don't want to say too much about this, on corporate financing, you'll cover that in other courses, but what I want you to remember at this point is that it's also common that a company can decide to merge in order to reduce its overall tax liability. So let's talk a little bit more about the search criteria. We've kind of looked at the overview of the, establishing the method of acquisition, the reasons for acquisition. So we've identified all of those. Let's say we now are ready to begin our search for a target company or a list of companies that we want to go after or pursue for a potential M&A. So we develop what we call search criteria. How are we going to identify our targets? And so the first thing we kind of look at is we have to consider the financial criteria. We want a company that maybe has annual turnover or annual revenue of a certain amount. We have to say, what about profitability? Do we want the company to be profitable? Or are we willing to look at a value-added merger where we think the synergies are good? But all of these financial considerations we have to evaluate. What kind of debt to equity, what type of growth potential, all of those are part of our financial criteria. We also have to look at the industry and market factors. Is this company or companies, what industries do we want to look at? If it's a vertical merger, we have kind of one focus. If it's a horizontal merger, obviously we're going to be working in the same industry. But we also maybe want to look with this as geographical, which is kind of the third one. Where do we want this company to be operating? And so we have to say, does this company have access to markets that we want? Are they operating in a correct part of the world that will meet with our goals? So the geographical focus is a part of this search criteria. Competitive environment. So if if competition is our goal, maybe we're going to look at a target company that has less competition because that gives us the bigger possibility of return. We don't want to buy a company that is one of 100 in the industry, because that won't necessarily translate in an increased market position for us. So oftentimes in a merger, we're looking at companies that don't have a lot of competition, because it gives us a better leverage, a better position once the deal is conducted. And then finally, the other factors that we consider: technology, IP, what kind of intellectual property does the company have? What's their customer base like? What are their clients? All of these things we have to consider, so we can look for a company that meets our needs, considering all of these factors. We also have to analyze the market. And the market analysis is both qualitative and quantitative. It means we have to look at the raw numbers, the quantitative, but we also have to go behind the numbers a little bit and look at what is the market going to do in the future. Is it a market in decline? Is it a market that has growth potential? So all of these things we have to evaluate before we pick a company. So what are some of the things that we look at to analyze a market? What kind of marketplace is it? Let me go back to my R.J. Reynolds analysis, because this is a good one. If you were a tobacco company and you're looking at maybe buying another tobacco company, you'd say, let's talk about the tobacco market right now. You know, you say, okay, we have a declining customer base. The market is changing. Do we think the tobacco industry is going to continue to grow, or is it going to get smaller? So this is a good example of an industry that maybe is in decline a little bit. Let me give you another example. Look at artificial intelligence. If you were thinking of buying a small company that has certain AI technology, your analysis of the market would be, well, okay, the AI industry right now is small. The numbers may not be, big right now, but the growth potential is huge. So you would analyze the market in this way. So these are kind of the elements of the market analysis that we have to do. And so finally, what we do is kind of bringing these two together. We have the company versus the industry competitor analysis. And these are the two that we have to do at the beginning of every M&A. We have to understand how how these two interplay. So with the company analysis, we do that first in every transaction. We have to analyze the individual company, what's its individual profitability, what is, everything about the company's history, its product, its quality. We look at how is the company performed in the market. What do we think the company will do in the future? So that's the company analysis we do. And then after we do that, we have to do what we call an industry competitor analysis. So this is the second part of this, and similar to what we were just talking about. What is the market? What is the market doing? The company operates in a market. We've looked at the individual company. Now we have to understand the market. Who are the most competitive players in this market? Where is this company in the marketplace? Is this, what are other competitors in the marketplace doing? So it's kind of a two-step analysis. We have to understand the company, and then we have to understand the bigger questions of what is the market or the industry like where the company is operating. We need to understand both before we can buy a company, because we could have a really poor company in a hot market, and the goal or the objective would be is say, hey, this company is performing very badly, but if we buy it, we can turn it around and make it profitable, and our prospects in this industry are really, really good, because this is a huge growth industry. Or what we can say is we can say, you know, we have a top company, RJ Reynolds, I'm kind of picking on tobacco today, that's a great company, but it's in a market that we think is in decline and is not really functioning. So we really need to have an understanding of both before we can correctly identify a target that makes the most sense for us. So let's kind of take a closer look at kind of the elements of a company analysis that we have here. So if we were doing a company analysis, say we have identified a company or a group of company, the first thing we're going to do is we're going to say, okay, what are the company policies? You know, what kind of products do they make? What's their financial capability? What's their performance in the market? We kind of break down the company by these individual things. We may look at what kind of legal barriers do they have? Are they a company that's regulated by the government? All of these, are they a company that's just come out of bankruptcy? All of this information we would include in our company analysis. On the other hand, once we've done that, we would look at more of the industry analysis or the competitor analysis. We would say, okay, this is the target company. Let's identify its competitors. Okay, what are the competitors doing? What are their strategies? Who are the top competitors in the industry? If we buy this company, who will be our top competitors once we acquire the company? We look at the competitors and we say, are these really strong competitors or are they weak competitors? Okay. And then we have an understanding of what the competition is going to be like. And then another thing we have to do is we say, okay, let's assume we buy this company and we enter the market. What is the response going to be from the competitors? How will they respond? Will we, you know, will they go and try to merge with somebody? So we have to try to predict and understand what this new merged company, what impact it's going to have on the marketplace. And so all of these things we take into account when we do an analysis of the competitors. And in reality, we really do need to do both in order to understand how our, you know, how this transaction, this targeted transaction is going to work out. So we've done all this. We've set our criteria. We've analyzed the market. We've analyzed companies. So now we arrive at a step in the process that's called target identification. Okay. We have gone through and done our research, and we've identified companies that meet our goals, our objectives. And so at this point in the M&A, we develop what we call a target list. And once we develop the target list, we rank them. And this is what, managers, M&A firms on Wall Street, Main Street, this is the process. We say we've identified 5 or 10 companies that meet all of our, or most of our objectives. Then what we do is we rank them. We say, okay, this is our first choice, second choice, third choice. Okay. So we put them in rank order. And then at this point, we do more research. We do more research to understand and really evaluate our first choice, our second choice, and our third choice. And based on this reevaluation, we may decide that we're going to put our third choice in the number 1 position. So we really confirm, and we maybe reorder based on additional evaluation. So this is our target identification process. And then we have, what do we do? Now we have arrived at our first choice, for example, and we have a checklist that we follow. And we go through this checklist and we say, is this target, how will it contribute to our strategy? How will it help us? We look at, what technology could be transferred to us through this merger. And we look at all sorts of criteria, for example, the size, the products, are all of these a good fit? Are we in a high growth market? If we're not, what are the challenges to this? We also look at cultural business synergies, long-term projects for growth. And then finally, we kind of say, okay, what are the overall market conditions? So these 6 points are really kind of the final checklist that companies go through once they've established their short list of targets. And so now we arrive at the point where we say, okay, we have our list, we know who we want to go after, and now we're going to go after them. And so this brings us to the part in the lecture that I want to talk about, which is the basically takeover defenses. So we have a situation where let's use public company, for example. This is where we're going to most see the presentation of takeover defenses. So usually, to set the scenario or the stage, the companies that become targets for an M&A or a takeover are companies that publicly traded companies where investors look at and say, the company's stock is undervalued. The company is underperforming. Maybe the company has inefficient management. So all of the analysts are looking at companies and say, this is a really good company, but its stock is really low. We think we can do a better job. Okay. And so say we've gone through this whole process and we've identified companies. So oftentimes what happens is hostile takeovers. As you can imagine, you're a public company and you're trading, and you learn that there's a bigger company that wants to acquire or take over your company. But the company, you're a target and you don't want to be taken over. And so now we have a process that we call a hostile takeover, which many of the M&As that happen, many of them are friendly takeovers, as we talked about last week, but often a number of them are considered hostile takeovers. And so it's important that we understand what happens in the transaction if a company doesn't want to be acquired. Okay. What happens if there's a hostile takeover? And so basically, how do we define a hostile takeover? So hostile takeover basically occurs once the buyer, the company that wants to acquire, announces, we want to acquire this company, but the management for the target company does not want to be bought, does not want to be acquired. And so because of this, the targets have a variety of defenses that they use to takeovers that we're going to look at. So we have two steps in this process when we have a hostile takeover. The first thing that happens when the buyer inquires if the company would be open to a takeover, the management says no. The acquiring company still wants to buy the target, and they go through a process which they call a tender offer that we're going to look at. And once the tender offer is made, the company says, we want to, and we are going to try to buy your company. The next thing that happens is the target company launches one or several types of what we call takeover defenses to try to stop the transaction. So we're going to spend a few moments now kind of looking at the various takeover defenses that occurs. We'll go through this part of the takeover defenses. Let's go for another maybe 10 minutes or so, Filippo, and then we'll take our break and then we'll come back. And after the break, if you want, you can present. So let's continue though our discussion of takeover defenses. So if I'm a company and I find out that I'm a target and I'm on the management board, I can launch a number of defenses to try to stop or to prevent a hostile takeover. And usually my strategies that we're going to look at, these are all kind of interesting. We're going to take a closer look at them together. But usually my strategy, if I want to prevent a takeover, all relate to devaluing the stock. And they're dangerous because I'm going to take action that will lower the stock value of the company because I want to make the acquisition less attractive to the buyer. And so we can divide the takeover defenses into two basic categories: pre-offer defenses and post-offer defenses. So let's take a quick look at some of these, which are kind of interesting. The first takeover defense that we have is called the poison pill defense. And as you see, a poison pill, it is how it received its name. It's a strategy that the target company uses to discourage investors from a takeover. So I'm a public company and I put a poison pill in place to discourage anybody from even trying, from even launching a tender offer, from even trying. So how does the poison pill work exactly? So I'm the management and we get everybody to agree to this poison pill, which basically is a rule that the company adopts, the target company, that sets a limit on the maximum number of shares, the maximum stake that a shareholder can buy. So say I'm Warren Buffett or Bill Gates, and I want to, buy into a company with this poison pill. It says I can only buy a limited number of shares, whatever the limit is set at. So how does this work exactly? Well, basically, if I want to take over the company and I've already bought my limit and the number of shares that I bought doesn't give me a majority or controlling interest, and I say, okay, I'm going to continue to buy more stock until I have a controlling interest in the company. But the poison pill operates like this. If I exceed the limit that was set by the company, any additional stock that I buy, my share value will be diluted. And basically what happens is other shares are going to be issued, free or deeply discounted shares to other shareholders, meaning that my value is so diluted that basically I can't really ever take over the company because the value of my investment will drop significantly. So poison pills are put in place to stop acquisitions or discourage investors from coming after stock. Say you're a new technology company and you've gone public and you don't want to be bought, and you're fearful that maybe a company could come in and buy your company, acquire your company because they look at your stock as being undervalued. You might use a poison pill, put it in place to discourage people from ever wanting to buy your company. And oftentimes, in an acquisition, some companies may launch a tender offer and try to convince the board or to drop its poison pill, or try to get the company to drop this as part of the takeover defense. So poison pills are usually pre-offer takeover defenses that are designed to discourage investors from trying to buy the company, because in summary, it makes it extremely difficult, if not impossible, for an investor to buy a majority share in the company because of the way it operates. So that's more or less the poison pill defense. So this next poison pill, or excuse me, this next pre-offer takeover defense is what we call the golden parachutes. You imagine a parachute, golden parachutes, and you see the picture we have on the side. So this is a pre-offer defense that companies adopt to discourage investors from buying in a company. So how does it work? Basically, what you have is, in a golden parachute defense, you have the top executives, basically all of the top executives. Usually when an acquisition happens, all of the top executives of the target company go away, and they lose their jobs after a hostile takeover, because when the company comes in, the buyer wants to have his own or her own management people in place. Usually the top managers, the top executives lose their job. So what do the golden parachutes do to stop an acquisition? This is kind of interesting and been the subject of a lot of controversy and discussion on Wall Street. So I am an executive in a target company. And so all of the management, the executives, we say, okay, if our company is bought, we have to be paid big bonuses, big severance packages. We get these big stock options. So how does a golden parachute work? If Warren Buffett buys my company and I'm a manager, based on my golden parachute rule that the target company has in place, I have to be paid $10 million. I need to be given 5% of the shares in the new company. I need to get a big bonus. So if I'm an investor and I'm going in to buy this company, and I say, based on their golden parachute rules, I've got to pay an extra 10 million, 15 million just to get rid of the management, that might really discourage me from buying the company, because I don't want to have to pay all that extra money to get rid of the management. So the golden parachutes can add millions of dollars to an acquisition. And traditionally, they serve as usually a strong deterrent to stop pre-offer, stop hostile takeovers. So that's the golden parachute. Now, this one is interesting. We talked about this last week with the R.J. Reynolds Nabisco merger. We have what we call green mail. And this is actually a very controversial defense. It's considered, it can be illegal depending on how it's conducted, but it's a very controversial type of hostile takeover defense, because it's considered to be one that's unethical and lacks transparency. So what happens in a green mail defense? So in a green mail defense, the green mailer, as they're called, goes in and buys up a big amount of stock in, basically a substantial stock of the company shares. So I'm the green mailer, and before I go in, I buy up a big block of the shares. And then I threaten a hostile takeover. And the target company can resist the takeover by repurchasing its shares at a premium from the green mailer. So instead of a black mailer, I'm called a green mailer, the green as in money. So say, Filippo, your company is the target, and I'm the Wolf of Wall Street, and I go in and I buy huge amounts of your stock before I announce that I want to buy the company. And then I go and I say, all right, Filippo, I'm going to buy your company, but you can stop this. You can prevent my takeover if you buy back all of the stock that I just bought at a premium. So you're going to pay in addition to the market value, I want you to pay 10% or 15% over the share price that it's trading at. And so green mailing is how you can stop a takeover defense or a hostile takeover. But so as you can imagine, just considering the operation of how the green mail defense works, this is usually a post-offer defense. But you can see why it's controversial, because it operates like extortion. I'm basically using a very predatory, very unethical practice. So green mailing is often subject to a lot of scrutiny by regulators, but this is how a lot of ruthless companies try to leverage money, or green mailing can be one way that they can stop a hostile takeover. But they end up paying a premium to repurchase their stock from the green mailer. But this is green mailing in operation. And then we have kind of a variety of post-offer defenses. These are, okay, we're going to look at, after we come back from the break, we'll look at tender offers, but these are kind of the remaining kinds of post-offer defenses. Post-offer means the company has received a tender offer, they don't want to be bought. Now we're sitting around and we say, how can we stop this tender offer from going forward? So these are really interesting strategies. Let's kind of spend a few moments talking about them. The first is what we call the crown jewel defense. This is an interesting name. Basically, when we say the crown jewel, we're referring to a company's most valuable assets. Okay, so I'm a company and I want to stop this takeover. And so what I start doing is I start saying, okay, the management decides we're going to start selling off our most valuable assets to third parties. And maybe we'll make side arrangements with them, or we're going to spin off companies into separate companies. But we're going to basically, the main goal here is to basically get rid of or move our most valuable assets to either a third party or spin them off into separate companies, so that our acquisition becomes less attractive. So if I'm a buyer and I want to buy this company, and now the company has transferred its most valuable or profitable assets, all of a sudden this merger doesn't look so good. And I say, okay, I want to, we're not going to buy this company after all. So this would be the crown jewel defense that stops an acquisition. The main goal is to make the target company less attractive, less desirable to the buyer. Then we have what we call the Pac-Man defense, and this is named after the old video game, Pac-Man. And so this occurs, this is an interesting one, when the target company attempts to buy its potential buyer when a takeover bid has already been received. So basically, I receive a tender offer from your company, Filippo, and I say, okay, well, you know how I'm going to respond to that? I'm going to respond by buying up shares in your company. So it's kind of who can eat who first. We call this the Pac-Man defense. And so basically, I start trying to buy you before you can buy me. This tends to be a very costly, destructive defense, but some companies, this is how they respond, is the Pac-Man defense, and they try to stop an acquisition in this way. And then the final one that I want to talk about that is used to defend a hostile takeover is what we call the white knight defense. Lena, we call this the white knight defense. And so the white knight defense occurs when you have a strategic partner. So say a tender offer is launched, and then we sit around, and we're the target company, and we say, we don't want to be purchased by this company, but we need to find a strategic partner. Okay. And so basically, we're sitting around and we say,
Good morning, Lisa.
hey, Leonardo, welcome. Glad you joined us. We say, we're glad that you are, we know we're going to be bought, but in order to stop the acquisition, let's find our own buyer. So this is really what we do is we say, we go and we find a strategic partner and we say, this company wants to buy us. We know that we can't stop our company from being taken over, but would you buy our company instead? And we may give concessions, we may agree to a more favorable takeover. So we call this the white knight defense. And what it is exactly is when we know we're going to be bought, but we try to identify somebody that will be a friendly buyer that we can collaborate with and maybe set up more favorable terms for our transaction. So these are basically the takeover defenses. When we come back from, we're going to take let's take 10 minutes. When we come back, we're going to look at tender offers and how those are made. How do companies launch the tender offer? And then Filippo, if you'd like, when we get back, do you want to do your presentation at that time, or
Yeah,
okay,
sure.
we'll do that. Leonardo, I did receive your slides. If you would like to present today too, you can do that. Or, as I said, I thought you might not be here today. We were going to do it at the next class. You can do yours as well if you'd like, but you don't have
Okay.
to. Okay.
I don't know. It's the same.
Okay. Well, let's do
Maybe
this.
maybe
Go ahead.
it's
Yeah.
better in presence.
Okay.
But
Whichever you like, because
okay.
whichever you, Filippo's going to present his after the break, but if you wanted to, you could, or you can do it at the beginning of class next time based on our
Okay.
our prior agreement. Okay,
Okay.
let's go ahead. Let's take 10 minutes. We'll come back in 10 minutes and then we'll continue on. Okay.
Okay.
All right. See you guys on the other side of the break.
Okay. Thank you.
Okay. Are you guys back?
Yeah.
Okay, you ready?
Yes.
Okay, perfect. Filippo, do you want to go? I can make you, let me go ahead and start the recording before I forget. I can make you the host so you can show your slides, or you can send them to me too, and I can. What's easiest?
I can, well, the easiest would be to share the screen.
Okay, why don't I,
The,
yeah, let me do this.
But-
I'm gonna make you the host. You just have to make me the host, after you
Okay.
finish. Wait, let's see. I'm trying to make you the host right now.
But-
Make
no,
host.
you
Here we
don't need
go.
to make me move. Yeah.
I don't think you can share your screen.
Let's try.
Try. If not, I'll make you the host.
Okay. Let me just. Okay. Let's do this. 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 Can you see it?
Yeah, perfect. Okay.
Let me just do this because otherwise it's okay. Okay, so I did a presentation on insider trading,
Okay.
as I know Leo did it on Lehman Brothers.
Lehman Brothers.
But since I had already done one last year, if I'm not wrong, about Lehman Brothers or something similar, I
You
decided
did.
to do it on insider trading.
Okay.
First slide, what is insider trading? It's just an introduction, simple introduction about what it actually is and why it's considered illegal. So it's basically the practice of using non-public, therefore confidential information to buy and sell securities and to take advantage on the market. And it's illegal in most countries, of course, as it violates securities and laws and regulations that would make the market too easy, let's say, just to trade on if insider trading was allowed.
Mhm.
Then we have the Galleon scandal, 2009. We will let's just get into detail about it, more or less. So the Galleon Group was a prominent hedge fund managed by Rajaratnam. Let's call him Raj for the sake of
Yeah,
being
easier
a
to
little bit more.
pronounce.
Okay. We have the scandal details, which is basically was involved in a major insider trading scandal in 2009, where Raj and his associates used confidential information to trade stocks. The criminal case against Raj here. We have arrest and charges. Who was arrested in 2009 and faced numerous insider trading charges. They were able to arrest him through wiretaps that captured incriminating conversations between him and some of his associates. And he was found guilty in 2011, 2 years later, sentenced to 11 years in prison and fined with $63.8 million. Sorry, 1 second. Okay. Nice. Then, what is insider trading and why is it considered dangerous and criminal? So we have different reasons. These I thought were the main ones, so the most influential and the most important, let's say, where it undermines market integrity and fairness, of course, because if I know information in advance, I know what to trade, and that's undermining market integrity. As I said before, it's unfair as it provides unfair advantage to insiders, to people who know information before others. It damages investor confidence in market fairness. This means that with confidential information and with a case of insider trading where people get more money and control markets based on information, this would discourage investors to invest in certain sectors or in certain companies or in certain markets. Then there's the SEC enforcement, which is the body that regulates financial transactions, and regulatory bodies actively pursue insider trading cases, so they're still investigating whether or not there are instances of insider trading. Capital allocation, as it distorts resource allocation due to the piloting of markets and deciding where shares go, where money is flowing the most, and all the different other examples. We have market efficiency, where it challenges the EMH that we will see later, the models. And global implications, they just can strain international relations and trade, because of course, if stocks and securities are traded with information in advance, this will cause an unfair advantage, and therefore the markets would be controlled by people or institutions that have information in advance. Then we have a relationship between insider trading and EMH models, which the EMH model here is the efficient market hypothesis, by the way. Explained in simple terms, you can say that stock prices already include all information. So this is an assumption of EMH, and making it hard to predict future prices. So this works like the Homo economicus concept, which is that there's the assumption that markets and people who trade stocks all have the same information and are all on the same level, so that the future prices cannot be predicted. Then we have insider trading against EMH, which means that insider trading contradicts EMH because it's about using secret information to gain an advantage. So if this would basically contrast the assumption that every individual that is trading stocks have all the same information, and that the market has all the same information. Insider trading obviously goes against that. Then we have market anomalies, which is basically insider trading leading to unusual profits. That challenges again this idea. Then we have different EMH levels, which is semi-strong, that says that all public information is in stock prices. And then we have the strong form, where it claims that even private information, like insider trading, is in prices that will alter the price of the stock. And then we have a debate on a efficient market hypothesis, which is the relationship between insider trading and EMH sparks debate about how efficient financial markets really are, because we have to take into account the assumptions and take into account insider trading, the challenges, and everything. We can actually debate on how financial markets are efficient and how you can trust financial markets instead. Then we have my own opinion, where I think that from the personal stance, insider trading is a morally and ethically questionable practice in financial markets. However, I am aware of the fact that insider trading is everywhere, and that it's still a practice that it's used, and we know that there are companies that work at the limit, and there are companies that I know that, but I still think that it's questionable, because everyone should have the same opportunities, at least in the financial markets, right? Because if you trade with $10 million or with $10, I think you should have the same opportunities of getting money. Unless, of course, you are a manager, or you're someone that is controlling actually your market, then something different. And I support strong regulatory measures against insider trading to protect market integrity and ensure a level playing field for all investors, which is what I was actually saying in that.
Okay.
Then we have market stability and fairness, where we can say that market stability is referred to as insider trading can disrupt it by leading to anomalous stock price movements. So if I control stock price movements, I can decide where my stock is going to be, and I can alter the market. Unfair advantage, as said before, provides privilege to people that access confidential information. Market confidence, the presence of insider trading can erode investor confidence.
Mhm.
Then we have regulatory response, which is the SEC, as I said before, that can detect and prevent insider trading.
Mhm.
And in conclusion, safeguarding market fairness and transparency and trust is paramount in ensuring the continued integrity of financial markets, due to the fact that it should not be allowed to have certain institutions control the markets based on how comfortable it is for their business or for their affairs.
Outstanding. Great presentation. I have a couple questions for you. I wanna follow up with you on some of the points
Oh.
that you made, but very good presentation on the elements of insider trading. First question I want to ask you, if we look at the Galleon case, do you think that the court's sentence in that case was too severe, or do you think that, because that's largely considered one of the biggest insider trading cases ever. But I'm just curious, do you think that he deserved the sentence he got, or it was too severe? And tell me why.
Well, I think we also have to consider the fact that he was, from one thing or the other, he was managing $7 billion in assets. So
Mhm.
I think that it's it's contradicting, because we know that all hedge funds, all investment funds, and everything that it's between
Yeah.
works in that manner, right? Because we
Right.
all know how it works. But it all stays in the fact that maybe funds like BlackRock or like Vanguard or what it is, they just
Uh-huh.
work with governments, and they
Mhm.
work at the edge of the line where they can possibly go.
Right.
Right? He went past the line, so I don't think it's severe, because when you are managing that amount of money, when you're that important, like Raj in this case, that was founder, you know that what you're risking, right?
Right.
In any circumstance.
Right.
So I guess it's fine. I don't think it's too severe.
Okay, very good. So I like the way that you listed all of the different reasons why insider trading is considered a crime. And I'm curious, in your opinion, what do you think the most compelling argument? What reason is in your opinion, the strongest reason why insider trading should be a crime? What is the biggest risk to insider trading, or the biggest harm, I should say?
Uh,
So
I
what do
think
you
that
think the best reason is for making insider trading a crime?
I think it's unfairness, honestly.
Okay.
Going Because even if we don't think about global trade, and we think about market efficiency, and we think about all of those, but I think that if insider trading was legal to a certain extent,
Mhm.
it would not impact as much the other reasons as unfairness, because I just don't agree with the fact that who manages markets goes all profit, and who puts
Mhm.
money in it not knowing anything always loses money, right? Then I'm not saying that everyone should have the same money and everything that we can think of, but I'm just saying that unfairness is the biggest part of it, because if I don't know it, then you should not know it as well. Otherwise, I don't trade, and you trade on your own, and that's fine, I think.
Okay. Okay. So final question, and kind of leading to my last question. I'm your reference to strong EMH is interesting, and this is one of the big debates in the in the marketplace, where some people say insider trading has no effect on the market. And I'm curious, what do you think of the strong EMH hypothesis, that it's impossible for insider trading to have any effect on the market? Do you agree or disagree? And tell me your reason.
I don't agree with the fact that both that combining public and non-public information will make the market efficient, because non-confidential information have a much bigger impact on the market than
Yeah.
public information, of course. because if I trade Tesla because I know that on Monday they were going to announce that, I don't know, the cars are made of hydrogen and not anymore batteries, of course I
Uh-huh.
have a much stronger advantage compared to public information that is that maybe Tesla is designing a new engine that works with hydrogen, right? The weight of the two news and the weight of journalists and how they use it is much bigger for the confidential information. So I think I don't agree with the fact that there's no type of information that can give an investor an advantage on the market. I strongly disagree with that.
Okay, okay, very good, very good. All right, overall, really good job, really good presentation. You talked about all of the main elements of insider trading, and I especially appreciate your comment about the firms like BlackRock and others that operate on the edge. And the question is, you know, Galleon went over the line, but many people on Wall Street go right up to the line, and it's hard to understand where you've crossed.
It's a thin line between what you can or cannot do and to what extent, I think. So
yeah, I mean, you know, like it's interesting. BlackRock has relationships within the SEC. They have relationships with the government that they try to use to protect themselves. And so, you know, it's kind of another form of, you know, how fast can you move? How well can you protect yourself? But
yeah, how powerful you are, that's just the point.
yeah, very well done, very well done. Great job, Filippo. Please be sure to upload, or if you put your slides into Google Classroom, or you can send them to me, then I can review them and give you comments back. But overall, really well done on this assignment.
Thank you. I'll send it to you right now.
Okay, so let us go back to, let's go back to, we were about to take up tender offers. So we had been, before the break, we were talking, let me make sure. Yeah, it's going. All right. So before the break, we were talking about the process of a hostile takeover and the various defenses that a target can use to prevent a takeover, either defenses that you put in place before the bid is made and defenses after. So now what I want to do is I want to focus on the process of the tender offer. We kind of did this a little bit in reverse by talking about the defenses first, because I want to focus on the tender offers and how they get made, because this is a really strategic part of the acquisition process. And so we start our discussion with basically, what is a tender offer? You know, we hear this phrase get used all the time when we talk about acquisitions. And so basically a tender offer is the proposal, the formal proposal that an investor or a company makes. And who does the tender offer go to? The tender offer doesn't go to the management or the board of directors of the target company. Instead, the tender offer is made directly to the shareholders of the company, okay? So the offer is to tender or sell. So basically, I'm saying to you, this is my tender offer to you. I want you to tender, to give, or to sell your shares to me, the investor, at a specific price by a specific time. And usually the strategy of a tender offer is I will pay above the market price. So if I want to buy, you know, let's dream big right now. Filippo, you use the example of Tesla. Say I want to buy Tesla from Elon Musk, and so he doesn't want to sell to me. So I'm going to announce a tender offer today, and the offer is made to everyone who owns Tesla shares. I will give you $10,000 per share for your Tesla stock if you offer it to me by, and I set a deadline. And that's really how a tender offer works. I'm trying to work directly with the shareholders and give them an incentive to sell me their shares so I can obtain a controlling interest in the company. A tender offer is usually a cash or a securities bid that I said is made directly to the shareholders, the people that own the shares. And it's a process. It's done without, I don't tell the company's management, I don't want their cooperation, or I think I'm not going to get it. So the tender offer is usually made without consulting with the target company's board or management, and is usually done without, their consent. And the tender offer is really the first step in a takeover of the company. So if we kind of put tender offers together with the hostile defenses that we just talked about, after the tender offer is made, the company can go and try to put together the post-offer defenses that we talked about. For example, like the crown jewel defense. In response to a tender offer, I might start selling off the most important assets of our company to try to prevent the takeover. I might respond to the tender offer by offering a tender offer of my own to buy the shares in the, so all of these post-offer defenses can start after the tender offer is made. Now, if I've made a tender offer and I know that there's a golden parachute or, basically a poison pill, something that I'm going to have to negotiate, what I can do is I've made the tender offer. I can try to go to the management board and get them to drop the pre-offer defense, or I might have to try to live with it. But this is how the hostile defenses and the tender offers work together, or come into play together, I should say. So these are kind of the elements of the tender offer. But let's look at kind of like everything else in business. There are positives, there's negatives, there's pros, and there's cons. So what are some of the advantages of, I want to buy a company, I've targeted the company, I can either try to negotiate directly with them and see if we can make a friendly offer, or I can just launch the tender offer straight away. So let's look at the pros and cons of a tender offer. The advantages are basically three. If I launch a tender offer and I'm the investor, I'm not obligated to buy the shares until a specific threshold is tendered. So the way that the tender offer works, I say, I will buy, all of you shareholders, I will buy your shares for this price by this deadline. But in order for me to accomplish this transaction, I need to have at least 25, 35, 45% of all shareholders agree to my tender offer. Okay, so that's the threshold, because otherwise it's not worth my value or my time. If I'm an investor, I make a tender offer and only 5% of the shareholders respond, I've agreed to pay a premium or a higher value for their stock. But if I don't get a big enough response, I don't have control of the company. So I have to put in my tender offer a threshold saying that I will only do this if this percentage of shareholders respond. Okay. And so this is a good thing if you're an investor, because it means you don't have to put your money, you're not obligated to buy shares until you are assured that the number that has responded will give you a controlling interest. The other thing that's good about using a tender offer is you can also add to your tender offer what we call an escape clause. And escape clauses are good. So let me give you a good example. I want to buy a company and I make a tender offer. And the government, the SEC comes in, or, in Europe, the regulating body comes in, wherever you are, and says, I'm sorry, Lisa, you can't buy this company, because if you buy it, you will be violating antitrust law. It will result in you having a monopoly in the industry. And so I say, oh, that kind of stinks, because now I'm buying this company and the government is going to declare me an antitrust violator. And so it's going to complicate my transaction. So I can anticipate this in my tender offer by including what's called an escape clause. And how does the escape clause work? Well, it says that if the government rejects the tender offer because of an antitrust, I can refuse to buy the tendered shares. So it gives me a level of protection as an investor. I have a threshold saying I need this many shareholders to agree to sell, okay? And I also have an escape clause that says, if the government comes in and says I'm violating antitrust laws, I can back out of my tender. I don't have to buy your stock, okay? And so the third advantage with a tender offer is that it's a way for me to gain control of a company very quickly. Because if my tender offer is successful, I can gain control very quickly by dealing directly with the shareholders. I don't have to participate in long negotiations with the board and the management of the target company. I can appeal directly to the shareholders. And if my tender offer is good enough and I get a big enough response, it's a mechanism that allows me to take control of the company very, very quickly. So these are all the advantages of tender offers. And if you were an investor on Wall Street, or you were trying to, your company was trying to buy another company, these would be all things that you would say, these would be reasons why we can try to issue a tender offer to buy the company. But let's look at the other side, because there's also disadvantages. There's also disadvantages to tender offers. So let's talk about some of the disadvantages. So a tender offer can be a very expensive way to complete a hostile takeover. Because if the company, I launch my tender offer, and then the company decides to use takeover defenses to stop me from buying the company, all of a sudden it becomes very, very expensive for me, because I've got to hire attorneys and advisors and other specialists to try to manage the transaction and outmaneuver the company who's engaged in a hostile takeover defense. So a takeover can also be very, very expensive. I just said that a tender offer can be a way that you can acquire a company very quickly. It can also be a very time-consuming process if, for example, the government steps in and says, we want to review this transaction because we think there's, we have to verify the shares. We are concerned about fraud. We're concerned about insider trading. We're concerned about green mailing. We're concerned about antitrust. And so if the government gets involved, it may slow down the transaction. If the banks are stepping in saying we need to review some of the outstanding, investment loans, whatever, all of these things can slow down the transaction and be very time consuming and expensive. So for example, if I have to verify the tendered shares, meaning is this shareholder truly own the shares? All of those things can be very costly and time consuming. The third disadvantage of a tender offer is that if it turns into a hostile takeover, okay? Now, for example, there's a hostile takeover to my tender offer, and I'm really committed to buying. It means I could increase the price of my tender offer, increase the offer, or now I'm spending a lot of money to try to buy a company that's resisting to be bought. It can also be very, very expensive. So basically what I want you to think about here is that tender offers there are pros and there are cons. There's advantages and disadvantages. If the target company decides to really fight, they can become very expensive. If the target company is basically saying, you know, okay, we don't like this, but we're not going to fight this. This can be a really good way to take control of a company very quickly. And so how do we know the difference? If we're the investor or we want to buy the company, how do we know the company's likely response? And this brings us to kind of the last thing we're going to talk about in this lecture, probably the most important thing, because it's the biggest step in the M&A process. It'll also be the topic of your homework assignment for next class. But this is the due diligence process, part of our preliminary investigation analysis. Before we launch a tender offer, we will want to investigate the industry, investigate the target company, understand how they're being operated, how they're going to respond. So this is all kind of part of the due diligence, doing your homework so you can understand the company. And so let's turn, if we can, now to the topic of due diligence. Of all of the steps in the M&A, this is probably one of the most important steps, because this is the first big step after we've identified our target, we've identified a buyer, a seller, we're committing to a transaction, but this is the process that allows both the buyer and the seller to understand each other, to understand what they're buying, what they're selling, before a legally binding purchase and sell agreement is entered into. So I've worked on a lot of due diligence reviews in an M&A transaction. They are very expensive, time-consuming, but they are very, very important, because oftentimes you find out in due diligence that nobody anticipated that there was a lawsuit that was going to cost the new company millions of dollars in the future. Or we don't understand that there were huge losses that were not reported. So all of the due diligence is aimed at helping us understand exactly what we're buying, so that we can manage the risk, we can confirm that the purchase price is correct. And so this is probably the most important step in the M&A process, because if we haven't done our homework, if we haven't done our due diligence, it means that in all likelihood, the merger will fail, because we didn't go into the transaction knowing the full details of how the company that we just bought is operating. So let's look at kind of the buyer's duties, and then we'll look at, kind of the responsibilities that each side has to undertake. So let's start with the buyers. So at the beginning of the process, okay, we have a friendly merger, for example. We'll talk about it in this way. I'm the buyer, and you guys are going to sell me your company. You say, Leonardo and Filippo, you guys own a company, and you've agreed to sell your company to me. The first thing that I am going to want from you both is what's called warranties and indemnities. Okay, I'm going to ask you guys to give me a legal assurance that your company is what you represent it to be. For example, you tell me I have 10 million in turnover, Lisa, and I say, okay, I want you to give me a warranty that shows that you have 10 million in turnover, because you can tell me 10 million, and then I look at your books and I say, well, you only have 3 million. We have a little problem here. Okay. So that's the first thing I'm going to ask for. The second thing is indemnity. Indemnity means that, if your company did something that, like you have a liability that is yours, it's not mine, I might say to you, I want an indemnity. You had this liability while you own the company. I buy your company, but I want you to indemnify me. I want you to pay for your liability because I don't want to assume that, or maybe we negotiate something else. But the first thing the buyer is going to want to, clear in this transaction are warranties and indemnities. So I'm protected as I walk through this due diligence process. And so the buyer at the due diligence stage is going to be proactive and is going to try to do an independent investigation. Okay, so if it's a target company and a tender offer, I am going to do as much due diligence on this company before I launch a tender offer, so I can understand if they're going to be hostile and resistive, or they're going to be, cooperative. If it's a friendly merger, we had an initial discussion, but now before we sign the final paperwork on the transaction, I've got to do an independent investigation as the buyer to confirm everything that I think I saw as value. I have to confirm that you own your IP. I have to confirm your financial statements, so on and so forth. So all of these things are, part of the buyer's duties and responsibilities once we get to this state in the process where, all right, I want to buy, you want to sell. Now we have to do due diligence before this price will be confirmed. So, because what happens if I do a due diligence review and you give me your financial statements and records and I'm looking through them and I say, this is very interesting. Going back to my turnover, you told me you had 10 million in turnover. You only have 6. As it turns out, the value that we thought your company had is less. We're still willing to buy your company, but because the value of your company is less, we want a different purchase price. So often during due diligence, the terms of the transaction, the price of the transaction are often adjusted based on what we find out during the due diligence review. So this is a really, really important part of the process. So when we say due diligence, this is also important, and I kind of want you to think about this, especially when you think about the assignment that we're going to talk about at the end of the lecture. Due diligence is kind of a general phrase that under the title due diligence, there's many different kinds of investigations and review. And we can break them into 2 basic categories: financial due diligence and legal due diligence. Okay. So the types of due diligence review that we have, commercial, viability, what kind of products, we've usually done this, but financial due diligence means what's your profit and loss statement, what's your debt to income, what's your profitability, all of that is part of the review. And once we are in the due diligence, you as the seller have to agree to give me access to all of your financial statements and records so I can conduct my review. The financial review obviously too wants to look at tax due diligence. If you have a big tax liability to the government, if you have unpaid taxes and the tax authority has, is trying to seize some of your, inventory or your property, I want to find that out before I buy your company. So I want to know what your tax liabilities are. Legal due diligence is also really important. These are the legal due diligence is what I did a lot of when I was practicing law, where we go in and we want to understand we were talking about R.J. Reynolds earlier in the lecture, Leonardo, and Leonardo remembers this discussion from last week. If we're buying a
Yes.
tobacco company, I want to say, well, wait a minute, how many lawsuits does your company have before we buy this transaction? Or you're a company that maybe makes chemicals, and there's lawsuits that relate to environmental damage. Before we buy this company, you know, I'm doing the legal due diligence. I show up and I say, give me all of your records and documents so we can understand how many lawsuits, how many claims are pending. And then I go through and I say, all right, these lawsuits look like they're nuisance lawsuits. We expect they're not going to go anywhere. They're going to be dismissed. However, these 4 over here look like you have liability that could be anywhere from 10 to $15 million or euros, wherever you are. So this is part of the legal due diligence review. You want to understand as the buyer, what am I buying? If I'm buying a company that may have 5 million in tax and legal liability, I discover that through the due diligence. And so what do I do with that information with the due diligence? I can either say, I'm not going to buy the company, too much problem, or I can say, because of these new liabilities I've discovered, I want to reduce the purchase price. That happens. Or third, I can say, we'll still buy the company at the price. However, you, seller, have to indemnify me, or you have to agree to pay for any judgment from these lawsuits. So this is how due diligence operates, and this is why it's so important, because if you buy the company and then you discover, oh my God, I had no idea that this company now has 10 million in liability, that puts you in a very different position than you knew when before you bought it. And like I said, I don't want to simplify this, but you think about it, you're buying a car. Say you're buying a very expensive car and you don't really test drive it, but you buy it anyway. And then the first time you drive your car, you realize the engine's not working, or the engine doesn't work very well. There was a problem with the engine that I didn't discover before I gave the dealer a check for the new car. This is really how due diligence operates. It's the opportunity that the buyer has to discover any problem or concern or issue with the company. The bigger the company, the broader the company's product line or type of industry they're working in, the more complex and long the due diligence process is going to be. So basically, a couple more comments on financial due diligence, because again, legal and financial are the kind of the 2 areas of due diligence that are most important. In financial due diligence, we want to say, okay, your profit and loss, your profitability, but I also want to look at your accounting practices. And, do you have a lot of debt? Do you have a lot of cash on hand? Do you have, like, if you're a public company, you want to look at what are your trading results? What's happened with your stock? All those kinds of things. And as part of my financial due diligence too, I want to look at what is your overall financial health as a company. For example, do you have a lot of employees? Do your employees, are they efficient, inefficient? What is your human resources like? What is the management like? Are you inefficiently managed? So all of that is part of your financial due diligence review. And, last week and earlier today, we talked about if you're a company whose stock is viewed as undervalued, part of the reason why you become attractive as a target for a takeover is because an investor or another company believes they can operate your business more profitably and more efficiently. So often in a due diligence review, the financial review is going to look at, yeah, this company is losing a lot of money, but they have too many employees. They're not operating in the right markets geographically. They have a bad supply chain, you know, on and on and on. So the financial due diligence review tends to be very, very important at this stage to if the company's losing money, we want to go in and understand why, and hopefully confirm our conclusion that we think that we can operate this company more profitably. So kind of to just, you know, a little closer look at the financial review. So I am going to go in and my financial review, I want to find out if there are any undisclosed or unknown issues that could impact the purchase of the company. For example, I can go in and as part of my financial review, I see that the company has these very, very expensive supply contracts with vendors. And I look at them and I say, wow, these are supply contracts that won't expire for another 4 years. And it looks like we're buying, you know, raw materials or supplies at a price that is not very efficient, is over what we could do. So we have to understand, are we coming into a company that has, you know, financial arrangements, obligations? You know, you could find out the company has a line of credit with a bank at a very high interest rate, they have other creditors that they've borrowed money from that have high rates of interest that are going to complicate our transaction. Those are all things we want to discover in this due diligence financial review. We also really doing a couple of things. As much as we're trying to discover information that we didn't know, that was either undisclosed or unknown, we're also doing the due diligence to confirm information we already have. For example, we're trying to confirm our valuation of the company so that we know that the price we offered is correct. If we can't confirm it and we realize the company is worth less, we use the information that we identify to, you know, to say, okay, we need to adjust the purchase price for this reason. And the other thing we talked about, represent warranties and indemnities. Later on, when we get to how do we close the transaction, the purchase agreement that we actually put together, we'll talk more about warranties and indemnities, but our financial review is going to identify certain things that we want the buyer to agree to pay for certain liabilities that we discover. And then finally, what we're also doing in the financial review is we want to understand what the capital requirements are going to be for the new company. So for example, we are going to acquire this company. We want to know, is the company undercapitalized, or do they have capital on hand that will allow us to continue the operations? If they're undercapitalized, we need to plan for that as part of the acquisition, because they're going to need money up front to continue operations once we make the acquisition. So we have to have an understanding of what their cash flow is and what their capital requirements are going to be, because that's going to affect our financial planning as a company. So these are all the important reasons of a financial review. So of course, the world needs lawyers, right? We probably have too many of them, but the financial review is very important. But the second area is when the people like me come in to do the legal review. And this is probably as important as the financial review, because we basically have to look at, basically, I say that I'm going to buy your company, Filippo and Leonardo. We'll stay with my example. And you tell me, well, we own this factory here in Lombardia. We have another factory somewhere in Germany. And, these are all of our equipment, our machinery. And I'm one of the lawyers, and I go in and I say, okay, I'd like to see the title that you have showing that you own the factory here in Lombardia. I want to see the title to confirm that you own the factory in Germany. Okay, so that's part of the legal due diligence review. Because if I see, oh, I see you own the factory here in Lombardia, but you have a minority owner, you only own 60% of it. So now I say, okay, I didn't know that, so you can only sell me 60% of what you own. And so now, as the prospective buyer, I have to say, okay, now I have partners that I didn't anticipate, or there may be something in the contract that says, if you sell your factory, you have to offer it first to your partners before you can offer it to me. So these are the kinds of things that the legal review does. So if you say you have a patent, as part of the legal review, I have to confirm that you actually own the patent. If your company has lawsuits or threats of lawsuits, I have to go in and evaluate, as part of the legal review, what the status is and how that may affect the purchase price. So these are all important aspects of the legal due diligence. Okay. And so the legal due diligence usually focuses on, as I said, the title to the assets. We've talked about that. But also, it's what we call legal compliance. I want, before I buy this company, I want to be assured that not only do you have all of the titles to the real property, to the assets of your business, but I also want to make sure that you have a license. Suppose you're an oil company, or you're extracting raw materials in a country in Africa, for example. Before I buy your company, I want to see the license that you have to conduct your business, the permit. If you're a construction company, do you have permits to construct on the project? Whatever it is, if you're operating in an industry that the government controls, as part of the legal due diligence review, I want to see the regulatory approval that you have, because the last thing I want to do is buy a company, and then the next thing I learn is that the government is knocking on my door saying, we're here to audit you because you're not in compliance with this regulation or this law. So these are, as you can kind of see how financial and legal due diligence, they operate together. They're both really important. And if anything is not correct, you have to use this process to uncover that there may be a problem with this business. So this is what due diligence is designed to do, is to make sure that the company you're buying is, the valuation is correct, and that there are no unknown or undisclosed problems that you as the buyer don't want to have to take responsibility for. Intellectual property, just kind of want to say this really comes as part of the legal review, but it's really important because obviously, if you're like a value-added merger and you're saying that, we want to combine our complementary skills, they have this technology and this patented, process that will really work well with our company, or they have this trademark. All of that is really important. And so especially with IP, it's really important in the due diligence that you confirm who owns the IP. If it's, a due diligence process can show, well, we've applied for a patent, we haven't received it yet. We've applied for a trademark, we haven't received it yet, or we've applied and we've received. And so intellectual property is, a big part of the legal due diligence review. And finally, just a quick comment on another important aspect of your due diligence review. This one kind of comes under financial and legal. So I've listed employees because one of the things you're going to want to understand is who are the employees of the company that you're buying. Do the managers in the company have big employment contracts that have, as we talked about the golden parachutes. Now, if I buy this company, do I have to pay bonuses and severance and premiums to the upper level management to get rid of them? So part of the process is, who are the employees? How big is the workforce? I've got to look at that in my due diligence too, because the human capital can be very expensive, especially if you're buying a company that has, managers that have big contracts that you're going to have to pay in order to bring in your own managers and replace the management of the old company. So that's kind of the financial and legal due diligence review and the things that they're aimed at. Just before we get to the homework, we're almost done with today's lecture. I want to tell you about the final part of the process, because you guys could be out in business someday working on a due diligence review. And so these final two slides, I want to talk to you about what we call the data rooms. And I, again, having worked on a lot of these, the data room is a phrase that's used, and it's actually a physical room that is established. So say the merger's going on, the buyer wants to buy the target. What the target ends up doing is either in their company or usually at the office of the lawyer, they establish a data room. And it's a physical location that's secured, where access to the room is restricted. And it's a physical location where the seller, the target company, brings all of its financial data, all of its documents, and it's a secure room, and it's the place where actually the review happens. And so back when I was practicing, if I was working on a due diligence review, I would be in the data room. We might have an accountant, we might have other, kind of technical experts with us, and we would go through and we would be looking at the documents that the target company provided. Show me your leases, show me your titles, give me all the information on this lawsuit. And so the data room is a secure location that the objective is to encourage the seller to disclose all of their confidential information in a safe place where the buyer's representatives can review and finish the due diligence review. So the data rooms, as I said, are traditionally physically secure rooms that are monitored, and they're either in the law firm, they can be in the seller's office, they can be in the seller's law firm, and basically it's a neutral place where the due diligence reviews are happening. It's very interesting now because it's changed a lot, even in the few years since I went into teaching full-time instead of practicing law. But because data is stored electronically now, these data rooms also have kind of an electronic secure server component to them to facilitate reviews, because as you guys can imagine, traditionally documents were maintained in paper form. Now most companies are maintaining documents electronically. So the nature of these data rooms are also changing. But again, the idea is to establish a secure location where we encourage the seller to share information. So this, in a nutshell, is the due diligence process, which is financial and legal. And it's the purpose of the due diligence is not only to discover information, but also to confirm information, okay? To kick the tires, to assure yourself as the buyer that the company you're buying is worth the value or the investment. And as you guys can imagine, when you're paying millions and millions for companies, and sometimes the transaction we looked at last week, billions of dollars, you don't want to proceed with the purchase until you're able to confirm the transaction. Okay? So this, in a nutshell, is the start of our M&A process. This is an overview of how we engage in strategic planning and how we conduct our due diligence review, the beginning steps in an M&A transaction. So with that, if you guys have any questions, let me know. Otherwise, let's take a few moments and let's talk about the next homework assignment. So the homework assignment is on due diligence. And so it's going to follow the same format that we did for the insider trading Lehman Brothers assignment. So what I'm going to do is I will give you guys the option of you can do this together as a group or you can do it individually. It's up to you. The idea is I want you guys to, and it's the same, about a 10-minute presentation, 5 or 6 slides or so. If you do it as a group, I want you to divide up the work equally. If you do it individually, obviously that's not the issue. But what I want you to do is prepare and present it in the same way. After you present it, I'll ask you questions. You can do Google research, you can use the internet, you can use an AI search engine as long as you're using it following the policies for AI use in the syllabus. Okay. So what is the substance of this assignment? So what I want you guys to do is I want you to give a presentation on due diligence. And so what exactly does that mean? So I want you to, I'm going to let you choose the merger or the M&A deal that you want. I want you to do some research, find an M&A transaction that you say, wow, that's interesting. That looks interesting. Could be Fiat Chrysler or, you know, any other big M&A. Just you decide a deal that interests you. And what I want you to do is once you find the M&A deal that interests you, I want you to describe the general due diligence process that they followed. So if it's a, you know, if it's Fiat, for example, what did they do? Did they examine the financials, the legal? If it's a company where IP was at stake, did they look at that? So basically, I want you to describe the due diligence, the legal and the financial that would be involved in the transaction, given the nature of the company. If it's a company that did business all over the world, you know, what was the due diligence review, so on and so forth. And the outcome. Sometimes, as you'll see when you conduct research, that after the due diligence review started and certain liabilities or problems were identified, you know, Disney Pixar, for example, the price changed. What was the outcome of the due diligence review? Did the price get adjusted? So that's what I want you to look at, is basically 2 things. Describe the due diligence that was done and what was the outcome. the deal fell apart, the price was adjusted, or the price was confirmed. And the idea of this assignment is to have you use the elements, the things that we've talked about in this lecture today, and think about them in the context of a real world M&A. And if you do it in this way, the idea will be, okay, now I understand in practical ways how due diligence is carried out and why it's important. Okay, so that's the assignment for next week. Okay, any questions?
No.
No.
Okay, if you guys have any questions, once you start, just let me know, send me an email. I'll either answer by email, or if we need to talk, we can talk. So,
Okay.
anyway, okay, very good job. We finished a few minutes early today. We will see one another next week in Brescia in person. And I will go ahead and post the lecture notes for the next class on Google Classroom. Just to confirm, are you
Tomorrow
guys...
we don't have lesson.
No, we had it today because
Okay.
because we are going to Warsaw, because there's a BusyNet, a big international conference of all the business schools that Stefano, myself, others in SSM are going to. And hopefully it'll be a good conference, because we're going to find out opportunities about study abroad, about international weeks. And so hopefully the information we get at this conference is going to help us offer even more opportunities to you guys. So it's one of the big international business conferences of the year for business schools like SSM. So anyway, I will see you guys next Tuesday. Oh, I'm sorry. Just to confirm, when I post to Google Classroom on our venture capital private equity space, you guys are getting the emails, right? That say, I've just posted something. Yes?
I don't understand.
So when I put something in Google Classroom,
Yes.
like
Yes.
when I put the lecture, you receive an email telling
Oh,
you.
yes.
Correct?
Yeah.
Okay, I want to make sure that's working. So, okay. All right, you guys, very good. Well, it's thank you again for joining me today for Monday. Let me know if you have any questions. Otherwise, I will see you guys next Tuesday in Brescia.
Okay, thank you.
Okay.
Bye.
Have a
Thank you,
great
Lisa.
week, you guys. All right, bye-bye.
Bye.